Continuing to talk about the accounting information system and how we take economic events, transaction data, and eventually translate it to the financial statements. The steps in the recording process are basic, and most all businesses follow these same basic steps. We've talked about analyzing the transaction and the effects of that transaction on the accounts. Illustrated that with a tabular analysis. We've illustrated that showing T accounts. Each transaction that occurs, each economic event should be backed up by something. It should have some type of evidence attached to it. This is called the source document. That could be a sales slip, an actual check, a bill, cash register tape. In accounting, we are very much about being able to prove the evidence of a transaction. This becomes even more important the larger an organization is, because what your third-party auditors are going to do when they come in and audit is they're going to look for the evidence of transactions. They're going to want to see samplings of the evidence. We enter the transaction information first in what is called the journal. Eventually, we will take and transfer this journal information to appropriate accounts in the ledger. This is called the book of accounts. Right now, we're going to talk about journalizing the transaction. We'll eventually move to posting to the ledger accounts. So here we go with an illustration that begins to look at that process. We analyze the business transaction. We look at the source document and determine its effects on accounts. Our next step is to post that information into the general journal. Finally, we'll post that to our ledger accounts. So let's talk about the journal itself. Transactions are recorded in chronological order, so following date order in a journal before they're transferred to the accounts. Some of the contributions to the recording process are that the journal shows both the debit and credit effects on specific accounts for each transaction. Companies can use a variety of types of journals, but they need the most basic general journal. In an automated system, many of the ways that we enter our information don't actually require us to create a journal entry itself. But what happens is that the software creates it for us on the back end and behind the scenes. The journal provides us with this chronological record of transactions, which really does, between having the complete effects of the transaction and the chronological record of the transaction, allows us to prevent or locate errors because we can see the debit and credit amounts in one spot. The actual act of entering transaction data in the journal is known as journalizing. And here we have some information going back to our friend Sierra Corporation. So we're going to look at this October 1st entry where Sierra issued common stock in exchange for $10,000 worth of cash. Your books show a really good representation of a general journal. You can also find in many locations online Excel tabs or Excel templates that represent the visual representation of the general journal. This is what general journals actually looked like back in the day when we used real books to record all of the entries. So we know that Sierra, in their issuance of common stock in exchange for $10,000 of cash, had an increase in cash and an increase in common stock. We recognize that from our transaction analysis. Taking our understanding of the transaction and our transaction analysis, we then journalize this transaction. So we start with, when we're creating a journal entry, the first line, we start with the debits. We recognize all the debits first, and then we recognize the credits. We have the date. Remember, this is done chronologically, so we enter the date. Then we enter the account. The account title. Account titles are capitalized, remember, and they are not phrases. They're things such as cash, supplies, common stock, dividends, salaries and wages payable, salaries and wages expense, rent expense. And then we debit because cash is an asset and it increases with a debit, has a normal balance of a debit, $10,000. When you're creating a general journal entry in good form, you then go to the next line down and you indent the credit title. Common stock. Common stock increase. There's more common stock than there was before this transaction, and that is by the $10,000 investment, the exchange of $10,000 of common stock for $10,000 in cash. We place that in the credit column. We're going to look at the next transaction, the borrowing of $5,000 by signing a note, and look at how that would be entered as well. We start with cash increased. Remember, we've done this transaction analysis already. Our cash increased, our notes payable increased. They both increased by $5,000, keeping the accounting equation in balance. An increase to an asset account is through a debit. An asset account should have a normal balance of a debit. So we enter the account title, cash, and in the debit column we put the $5,000. We move to the next line and indent because this is our credit line. And we enter notes payable. We have the obligation now of $5,000. We increase that liability through a credit. Credits are the normal balance for liability accounts. Now let's look at another situation. The one where we purchased equipment for $5,000. We still start first line with a debit. Now we're on October 2nd, so you see that our date has changed. And we enter the debit part of this. So what increased? What asset increased? Well, equipment increased. Equipment is going to be debited $5,000. And then we indent and represent cash and the decreasing cash with the credit of $5,000. We've walked through 3 of the actual transactions for Sierra. Now let's look at what the actual general journal would look like with all of these in place. Here we show the entire general journal. You notice that there is a chronological order. We have October 1st, October 1st, October 2nd. Also included in many cases with your general journal entries is going to be a third line. That third line will be no numerical value associated with it, but it will have a descriptor characteristic. So it tells us why this particular entry was put into the books. We issued stock for cash. We issued a 3-month 12% note payable for cash. It provides a little bit of extra detail so that if somebody comes back to the general journal to try to trace possibly a problem and error, or look for something that may not be correct, or they're just looking for a why, the information is there. So we're going to take a minute and we're going to actually walk through what's called the do it. This is a problem that is encased in your books. It is on page 108. And I will verbally walk you through it. Take a minute to read this information. And familiarize yourself with it. You can hit pause so that way you can find the spot in your book, or you can jot down the details. And then we'll go ahead and do the general journal entries related to these transactions. So we'll go ahead and get started with the do it. And the first transaction says that we issued common stock to shareholders in exchange for $20,000 in cash. Has an economic event occurred? Is this an actual transaction? We have an exchange of common stock for cash. Cash is increasing. Cash is an asset. Therefore, we know that an economic event has occurred. It also tells us that the offsetting account, that the exchange was for common stock. We start by entering, and these are not as detailed, they're not on an actual form, but we will do cash, $20,000. When you are representing these, sometimes you don't have your debit and credit columns. Remember, debit is the left, credit is the right. You will always indent your credit line, and you will always have credits amounts to the right. You start with debits. The next account will be, the next line of the transactions will be your credits. And we credit common stock, the increase in common stock, by $20,000. And number 2 says that we purchased $4,800 of equipment on account to be paid in 30 days. So we know that we have a new piece of equipment with a value of $4,800. It increased, our equipment has increased $4,800. Equipment is an asset. The way we increase an asset is a debit. So we debit equipment $4,800. But the rest of it is not as clear as, say, in exchange for $20,000 of cash, we issued common stock. It says on account to be paid in 30 days. When you hear the words on account, I want you to think either accounts receivable or accounts payable. Accounts receivable is an asset, accounts payable is a liability. They both are expected to convert within the next year or the operating cycle, whichever is longer, making them current. So this is definitely going to be within the next 30 days. But we're going to owe somebody. We need to pay them. We have an obligation. Therefore, we have a liability. The liability account that says that we need to pay somebody in the short term is our accounts payable account, which will increase with a credit of $4,800. The third event says that we interviewed 3 people for the position of a stylist. Well, just talking to people, even just hiring them, are not economic events. There's been no change to our actual assets, liabilities, or stockholders' equity. By no means am I not saying that the human resource element, that are the people who work for an organization, are not an asset, an intrinsic asset. But there's not a value or an economic event associated with discussions or the acquiring of them. It is when we pay them that we then encounter an economic event. So there's a couple of things that you really want to keep in mind when it comes to journaling. And I'm going to flip this back a little bit, so please bear with me, for us to look at the representation of the actual general journal. First, it is absolutely paramount that you use the correct account titles when we are journalizing, because we take the information from the journal and we then transfer it to the ledgers. The wrong account name in the journal will result in posting to the wrong ledger, leading to erroneous financial statements. So, for example, on October 2nd, had we not put equipment, maybe we had put buildings, $5,000. We would then incorrectly be representing an increase in buildings that is not there. Doesn't mean we didn't have the assets. We just have it in the wrong spot. Mistakes like these can lead to many hours of research and correction problems in the future. That's why it's very important during your transaction analysis and your journaling that you use the correct and specific account titles that go with the economic effects of the transaction. One of the areas where you will find the accounts that are used by the company is in the chart of accounts. The chart of accounts is a list. They are typically listed in the order of assets, liabilities, stockholders' equity, revenues, and expenses. If a company has numbered accounts, those will be in the numbers of anything that starts with a 1. So like a 100, a 1,000, or whatever would be an asset account. Those that start with a 2 would be liabilities accounts. Start with a 3, stockholders' equity accounts. 4s would be revenues, and 5s expenses. Now, this is generally how that occurs. Companies can create their numbering or order their chart of accounts for your use in any way that they see fit, but this is kind of the industry standard. This is how we typically will see that. The journal itself, other than being the original source that we move everything from to the ledgers, just looking at the journal as you see it in front of you, just shows you what happened in the course of a month. It's not going to tell you what the balances are in particular accounts. It's not going to show you what the performance aggregates to, what your net income is per se, or any of those types of things. But it is much like a journal that you write. It tells the story of what happened. And when we think of, say, somebody who journals, writes down the things that happens in the course of a month, when we read a journal from beginning to end, we get the general story. We don't necessarily know how all of that information combines with information from prior periods. We don't necessarily know what the results are. That comes on later in the accounting information system. This is the general story. This is the narration. But it's very important because it is also an area that when there is an issue, we can come back to and begin the tracking to try to determine where an error might have occurred.